We all know Disney is a great company, but I recently sold all of my Disney shares in my portfolio, which was around 1.2%. In this video, we're going to be talking about why exactly I did that, as the end of 2020, Disney saw a pretty decent run up in its price, but in 2021, it struggled a little bit since February as it's kind of trended downwards. Prior to peaking around $200 a share back in March, we can see the previous all-time high before COVID hit was back in November of 2019, around $151 per share. The pandemic hurt Disney a decent amount when it comes to their theme parks, as that is a lot of in-person spending. So their revenue dramatically dropped in 2020, but the stock price itself has recovered past 2019 and beyond. So looking at the valuation and kind of what their earnings is, you'd expect a lot of the revenue to have bounced back already. But we see that Q1, they were still feeling the effects of the tail end of the pandemic, and most of that is really coming from the loss of revenues at their parks. So you see that Disney Parks and Experiences and Products down around 44%. Whereas the rest of the business was pretty much flat. If we look at when Disney peaked back in 2019, you can see that their revenue for that year or fiscal year was around $70 billion, which if we look at their price to sales ratio back in 2019, it was around 3. And for most of the years between 2015 and the beginning of 2020, the company floated around that 3 price to sales ratio. As you can see in 2021, with the decrease in sales and the elevation in valuation, well, the price to sales ratio has got a little bit higher. Okay, so obviously the revenues are going to be lower this year, but next year they'll be way higher, right? Well, if we look at a price to sales ratio that makes sense, around 3.5, we can kind of look at a forward metric or a forward-looking valuation based on something like price to sales ratio to say, okay, what should it be worth a year from now? We can use something like Finbox to look at what is projected for revenues in the full year of 2022, and that's $85 billion. So they are expecting, or analysts are basically expecting, the revenue growth to pick back up in Disney, and use something like that 3.5 price to sales ratio. That's a market cap that would be fairly reasonable, of around $300 billion. Well, the stock currently trades at $334 billion. So if it got to $300 billion as fair value by end of 2022, obviously not a great return. Hold on. What about Disney Plus? Doesn't that give it a higher price to sales ratio? Well, it would, if I would expect the revenue growth from Disney Plus to be massive. Now, they already have 100 million subscribers, which is a ton. And Netflix is around 200 million. So if they got to the same point as Netflix in terms of subscribers, how much revenue would that be adding? Disney also outlays in Q1 how much they're getting paid in revenue for Disney Plus. As you can see, the revenue is only around $4 per user. And I think there's 2 main reasons why this paid rate per subscriber isn't that high. It's only $4 per Disney Plus subscriber. And the first reason being you have international subscribers, so their rate is going to be lower than the US, as well as you have promotional bundles, as well as companies offering free Disney Plus to kind of get you into their own product. So for example, Verizon had a promotion where Disney Plus was essentially on them. And the expectation is around 230 to 260 million paid subscribers by 2024, which if we split the difference at around 245 million, that'd be around almost $12 billion, which is nothing to sneeze at. At its current 100 million, that's around $5 billion per year. And back at the end of 2020, the company thought that they would match Netflix by the end of 2022. So let's just say they get to 200 million subscribers. Using that $4 figure and 200 million subscribers, that would be around 11% of this expected revenue at the end of 2022. It's almost like you have to value the streaming services separate of the rest of the business. So this market cap is almost made of multiple companies and multiple ways of valuing that company. I think what's happening is with Disney's valuation is being more valued like Netflix. So we can look at Netflix's price to sales ratio to see kind of where that's trading at. Over the past 5 years, Netflix has traded between around like 5 and 10 when it comes to price to sales ratio. So if we say something like 7.5, 8 for a historical average, that's something you could use as a reference. I think it really comes down to, are you valuing all of Disney like Netflix? or are you valuing Disney based on its previous multiples, its previous earnings potential? Because also with Disney Plus, first of all, the revenue per subscriber isn't as high as Netflix, which I think is a pro and a con for Disney, because $7.99 a month is a pretty solid price point. But at the same time, they're kind of anchoring that price for customers coming in. And if they try to raise this in the future to $12 a month, people are going to be upset unless there's a ton of new content coming out. So I don't know if it deserves such a high multiple for that specific business. And then also you have the fact that it's going to cost money to create that content. So it's just not free revenue coming in. They're going to have to keep up to date new shows and constantly invest back into that business. And it's not supposed to be profitable until like 2024. And if you're an investor that cares about earnings per share growth and all that good stuff, then it's going to be a little while. So it just feels like right now Disney has quite the premium built into the stock price. You hold on to it for 5 years, I'm sure it will eventually continue to grow. And I could be completely wrong. The valuation multiple, maybe I'm underselling it, and it should be 10. Disney Plus and Hulu and ESPN Plus, it's gonna make them a ton of money in the future for revenue, and I'm totally underselling it. The other unfortunate item related to Disney is their balance sheet and the debt that they have. So in 2019, they added a decent amount of debt in order to acquire 21st Century Fox. Of course, they didn't know COVID was gonna happen, in which they had to raise more debt in order to make sure that they had enough liquidity to operate the business and kind of relieve some of their financial pressures. And because they already have that debt on the balance sheet, they may not take out more debt in order to fuel growth, whether that's streaming services or building another park. They may just go ahead and just try to pay this down. So going back to their earnings per share, that may put a little pressure on their earnings in the future as they have to pay off that debt and pay the interest. With all that being said, I would totally buy back into Disney. It's a great company, like I said, and it does have that nice streaming growth in the future. I just think it's built into the price and valuation right now. So if Disney pulled back to 140, 150, that would give me the upside to kind of get back to where we're at right now in a year, and I would feel pretty good about picking up shares at that price. Here, I think we may trade sideways for a year and a half, looking at Disney maybe from a year from now. If it's trading around 180, $200, then hey, maybe it's at fair value at that point for the future. Feel free to cuss me out in the comments if you are a diehard Disney stockholder, and give me some of your thoughts around where you think Disney may go. If you did enjoy this video, give it a thumbs up and consider subscribing to Main Street Wolf, where we talk stocks, investing, anything to do with money. Thanks guys for watching, and have a great day.